The goal of active equity investing, as opposed to passive index investing, is to identify stocks that are mispriced relative to their true values. Investors buy stocks that are priced below their true values and sell stocks that are priced above their true values. Unfortunately, investors can never really know the true value of any asset with certainty. Instead, they can only get estimates of true value using measures that are derived from observable financial data. Common stockholders expect to be rewarded through periodic cash flows or dividends and an increasing share value. They recognize that equity investments are risky and demand an expected return that compensates them for the level of risk they incur from investing in each stock. Some of these investors decide which stocks to buy and sell based on a plan to maintain a broadly diversified portfolio that minimizes stock-specific risk and earns the highest reward to variability ratio. These investors earn a higher reward by identifying stocks that are mispriced. For example, a well-diversified portfolio of low beta stocks will have a higher expected return if the investor adds underpriced low beta stocks to the portfolio. Other investors are more speculative in nature. They actively buy shares that they reckon to be undervalued and sell shares that they think are overvalued, and these speculators tend to be less concerned with maintaining a broadly diversified portfolio, and they often hold stocks only until the prices equal their perceived true value. Diversified and speculative investors compare estimates of true stock value to market values. But how does the market value stocks? Are the market values reliable? If not, finding mispriced stocks will be easy. However, we know that beating the market, which is the equivalent of regularly finding mispriced securities, is difficult. Why is that? The law of one price ensures that finding mispriced securities is difficult, and any mispricing that does occur will often be small and short-lived. The law of one price ensures that economically equivalent stocks will sell at the same price. This is because any violation of the law of one price is an opportunity to earn arbitrage profits by shorting overpriced assets and using the cash proceeds to buy underpriced assets. The arbitrager's demand for the underpriced assets will push prices higher, and the excess supply of shorted securities will push those prices lower. Economically rational buyers and sellers use their assessment of an asset's risk and return to determine its value. In competitive markets, with many active participants, the interaction of many buyers and sellers result in an equilibrium price, the market value, for each security. Because the flow of new information is almost constant, stock prices fluctuate, continuously moving toward a new equilibrium that reflects the most recent information available. This general concept is known as market efficiency.
The two most common approaches to evaluating and selecting stocks are fundamental analysis and technical analysis. Remember, when evaluating, we only estimate true values using available but always limited data. Better estimates lead to better stock picks, but there will always be some level of uncertainty. Why is data limited? Well, we can use historical data, but there's no guarantee that relations that held up in the past are going to hold in the future. Technical analysis relies on using past historical prices and trends to estimate future prices, not true intrinsic values. The goal of fundamental analysis is to determine a stock's equilibrium price or intrinsic value. Fundamentalists, those practicing fundamental analysis, hope to profit by purchasing stocks they estimate to be underpriced, whose market price is below the equilibrium value they have determined, and selling or shorting stocks they determine to be overpriced. Thus, the real objective of the fundamentalist is to earn abnormal returns by being able to identify mispriced securities. Our main focus is on common stockholders, but I want to take just a moment to talk about a different type of stockholder, the preferred stockholder. Preferred stockholders have certain privileges that make their claims senior to common stockholders. Preferred stockholders are promised fixed periodic dividends, which are stated either as a percentage or as a dollar amount. Par value preferred stock is preferred stock with a stated face value that is used with a specified dividend percentage to determine the annual dollar dividend. No par preferred stock is preferred stock with no stated face value, but with a stated annual dollar dividend. Preferred stock is often considered like a quasi-debt because much like interest on debt, it specifies a fixed periodic payment, a dividend, whereas debt would have a fixed interest payment such as a bond. Preferred stock is unlike debt, however, in that it has no maturity date. Because they have a fixed claim on the firm's income that takes precedence over the claim of common stockholders, preferred stockholders, like bondholders, are exposed to less risk. Preferred stockholders are not normally given a voting right, but sometimes we see preferred stocks being allowed to elect one member on a company's board of directors. Some of the features of preferred stock include restrictive covenants. These restrictive covenants are much like the restrictive covenants that we see on bonds, and bondholders have those restrictive covenants to protect themselves against the company's management pursuing strategies or policies that would endanger their ability to make their interest payment. The restrictive covenants on preferred stock work the same way. Restrictive covenants including provisions about passing dividends, the sale of senior securities, mergers, sales of assets, maybe restrictive covenant on a minimum liquidity requirements and repurchase of common stock, all designed to protect the preferred stock dividend from not being paid. Cumulative preferred stock is preferred stock for which all unpaid dividends and arrears, along with the current dividend, must be paid before the companies can pay dividends to common stockholders. Whereas non-cumulative preferred stock is preferred stock for which unpaid dividends do not accumulate. Valuing preferred stock is a relatively simple process, as the cash flows are known. The only input that we really require is estimating a required return. However, our main interest is in valuing common stock. The common stock of a firm can be privately owned by an individual investor or a small group of investors, or publicly owned by a broad group of investors. The shares of privately owned firms, which are typically small corporations, are generally not traded. And if the shares are traded, the transactions are among private investors and may even require the firm's consent. In contrast, large corporations are publicly owned, and their shares are generally actively traded in the broker or dealer markets. Kind of a reference comparative scale, the Federal Reserve estimates that the value of all publicly owned firms is about $31 trillion in 2018 versus only about $5 trillion for private firms. So public firms are much larger in control, much more assets collectively than do privately held firms. Common stockholders are sometimes referred to as residual owners or residual claimants. They are the true owners of the firm. As residual owners, common stockholders receive what is left, we refer to that as a residual, after all other claims on the firm's income and assets have been satisfied. So this is after debt payments have been made, after preferred stock payments have been made, after taxes are paid, after employee salaries are paid, and so on. They get what's left over. They get that residual. Common stockholders are assured of only one thing, that they cannot lose more than the amount that they have invested in the firm. Because of this risky, uncertain position, common stockholders expect to be compensated with adequate dividends and ultimately capital gains. However, not all common shares have the same cash flow, voting power, and ownership stakes. Berkshire Hathaway, like many companies, has multiple share classes of common stock. For each share class of common stock, shares are further classified by authorization and circulation status. Authorized shares are the shares of common stock that a firm's corporate charter allows it to issue, whereas outstanding shares are issued shares of common stock held by investors. This includes both private and public investors. Treasury stock are issued shares of common stock held by the firm. Very often these shares have been repurchased by the firm. Issued shares are the shares of common stock that have been put into circulation, where issued shares is equal to the sum of the outstanding shares in the treasury stock. So for Berkshire Hathaway, they have two share classes, Class A shares and Class B shares, that have different voting rights and different cash flow rights, and each share class has issued, treasury, and shares outstanding amounts. And this is all in the footnotes to the consolidated financial statements, in other words, the annual report. As we discussed earlier, common stockholders expect to receive dividends and ultimately increases in share prices. However, the payment of dividends to the firm shareholder is at the discretion of the company's board of directors and is not guaranteed. Dividends can be paid in cash, stock, or sometimes the odd company may pay dividends in merchandise. Common stockholders are not promised a dividend, but they come to expect certain payments on the basis of the historical dividend pattern of the firm. Remember, before dividends are paid to common stockholders, any past due dividends owed to preferred stockholders must be paid. And yet, we see many firms do not pay a dividend, which begs the question, why don't all firms pay a dividend if this is what investors expect? Agency issues are one reason. Agency theory assumes that large-scale retention of earnings encourages behavior by managers that does not maximize shareholder value. Dividends, then, are a valuable financial tool for these firms because they help avoid asset and capital structures that give managers wide discretion to make value-reducing investments. This view also makes sense when one considers the rationale behind agency theory. Managers acquire control over corporate resources either from outside contributions of debt or equity capital or from earnings retentions. From an agency perspective, one advantage of contributed capital is that it comes with additional monitoring, because rational suppliers of outside capital will not be forthcoming with funds at attractive prices if they believe that managers' policies merit low valuations. Earned equity is not subject to the same ongoing stringent discipline. Accordingly, potential agency problems are higher when a firm's capital is largely earned, since the more a firm is self-financed through retained earnings, the less it is subject to ongoing discipline of capital markets. So dividends serve as a way to get excess cash out of the manager's hands so they cannot make bad decisions that destroy shareholder value. Another reason companies do not pay dividends is perceived growth opportunities. Some managers believe they can earn higher returns for their shareholders than shareholders themselves can make in the market. Berkshire Hathaway's Warren Buffett is in this school of thought. He discusses dividend at a recent annual shareholder meeting, saying, "We don't pay dividends because we think we can turn every dollar we make into more than $1 in market value. The only reason for us to keep your money is to make it worth more by us keeping it than it would be worth if we gave it to you. That's the test. If we come to the conclusion that we can't do that, we should distribute it to you." That's from the 2016 annual meeting. Valuing common stock is a pretty straightforward procedure, at least conceptually. So when we speak about valuation, we're talking about a process that links risk and return to determine the worth of an asset. There are three key inputs to the valuation process. First, what are the cash flows, or the return to the invested capital? What are the timing of the cash flows? We also need a measure of risk so we can determine the required return. Basic common stock valuation, then, is simply finding the present value of all the future cash flows. And for a common stock, those future cash flows are largely dividends. So if we think about a firm that has n number of periods where n is really, really large, the value of the stock would simply be the present value of all those future dividends. So the value today, V0, is equal to the present value of all these future dividends discounted at the future rate. So today's price is equal to next period's dividend discounted to today's dollar using our K rate of return, our K required rate of return, plus the dividend we're going to receive in period 2 discounted 2 periods at the rate K, and so on and so on. So the nth dividend discounted at the K required rate of return for n periods. Now, if the dividends are expected to grow at a constant rate, it simplifies things quite a bit for us if they're expected to grow at a constant rate over the entire life, this N of this stock. If that's the case, if we have the constant growth, then the value of the stock today would be equal to the dividend today multiplied by 1 plus the growth rate in dividends. In other words, how fast are we growing? So the dividend in the first period would be the dividend that was just paid at D0 multiplied by 1 plus G. In other words, grown at the dividend growth rate for one period, discounted by the K, required rate of return for one period. And this here would be period 2, and we do the same thing where the nth dividend is equal to the dividend that was just paid D0 multiplied by 1 plus the growth rate in dividends, raised to the power of n, discounted by 1 plus K to the nth power. Now, as that n gets really, really large, the valuation equation approaches a maximum value equal to D1 divided by KE minus G. At discrete ends, if we start talking like 30 or 50 years, this kind of holds. And you can look at Exhibit 3.4 in Chapter 3 for the mathematical proof. I'm not going to do that here. So for a company that expects to have a constant growth rate in dividends for the next 40 or 50 years, a profile that we could use to at least loosely describe many large companies today, the value of its stock would be, value today would be equal to the dividend grown at this 1 plus the growth rate divided by the difference in K minus the growth rate in dividends, or the value of a stock today times 0 is equal to the dividend in the next period, D1, divided by the difference in the required return in the growth rate in dividends. So by way of illustration, let's suppose investors are requiring a 10% rate of return on a stock that's currently paying a $5 dividend and is expected to grow at an annual rate of 3%. So the dividends, that $5 dividend, is expected to grow at a rate of 3% for the foreseeable future. So how do we go about valuing that company's stock? Well, again, applying this, we can check all the boxes, right? Constant growth rate in dividends, check. Happened in a really long period of time, check. So the value of this constant growth rate stock today, V0, would be equal to that $5 dividend that was just paid, multiplied by 1 plus the growth rate, that's our dividend in D1, divided by the difference in the required return, 10%, and the growth rate in dividends, 3%, and that would give us a valuation of $73.57. Again, the criteria is that dividend, that growth rate of 3% in this example, is constant for a really, really long period of time. Now that value of $73.57 would hold, even if we didn't hold that stock forever, even if we just were going to hold it for 3 years, as long as the selling price in 3 years, we could derive that as equal to the present value of the stock's future dividends at period 4 and beyond. So where we come up with, so we look here at this valuation, what would that look like? The value of the stock today would be equal to, what's the present value of the first period's dividend? What's the present value of the second period's dividend? And what's the present value of the sum of the third period's dividend and us selling that stock in the third year? And how do we come up with this $80.39? Well, in year 3, we can value that stock as long as that 3% growth rate forever holds. We can calculate the dividend in period 4 divided by the difference in required return and long-term growth rate, and that would give us a value of $80.39. If we plug that value of $80.39 in, and we did all this discounting, we come up with the value of the stock today is equal to $73.57. The same as it was in the previous slide when we just looked at holding the stock for a really long time.
So how do we estimate or come up with these constant dividend growth rates? Well, one thing we could do is look at the historical record, how dividends have grown in the past, and maybe make some inference about future long-term constant growth rates and dividends. Another way is we can calculate using the firm's return on equity and the plowback ratio. So we could estimate the growth rate in dividends by multiplying by the return on equity, how much the firm earns on its equity investments, multiplied by how much of the firm's earning is getting plowed back. In other words, how much of the firm's earnings are available for investment, so that therefore they can earn that return on equity investment. So multiplying the plowback ratio, which is 1 minus the dividend payout ratio, gives us an estimate of that growth rate in dividends. So let's see how an example of that would work. So again, using our basic valuation formula again for constant growth rate, And we have, for example, 20% return on equity. We have expected earnings next year of $5, a plowback ratio of 40%, and a long-term and a required rate of return for this stock of 15%. Well, first thing we want to solve for our long-term constant growth rate G. So plowback ratio multiplied by the ROE, that gives us an estimate of long-term growth rate of 8%. And then what's our payout ratio? Well, we know that if the plowback is 40%, so the firm's retaining 40% of its next year's earnings, then it's going to pay out 60%, so we'll have a dividend next year of $3. And applying our valuation formula, we come up with a valuation of this company stock of $42.86.
So what kind of firms can we use this constant growth rate formula for? This approach, this model? Well, again, large companies with really stable dividends. We expect the dividends to be really stable. So one company that kind of comes to mind, to me at least, is Coca-Cola. So let's take a look at Coca-Cola to get an idea of its dividend history and growth rate in dividends. So look here at Coca-Cola. So I went to Morningstar, get the most recent financials. I clicked on the key ratios here, and I'm looking for dividends, and I can see here the dividend record for the last 9-10 years. So I'm going to click on export here so I can open this up and in Excel make it a little bit easier to work with. And I'm cheating just a little bit here because I've already done the calculation. So I've got dividends here. I've highlighted this in yellow. So for Coca-Cola, we have the dividends. 2010, it was 88 cents. 2011 and 94 cents. In 2018 it was 12 cents, and in 2019 it was $1.60. So I can use my basic time value of money principle, right? $1.60 dividend divided by 88-cent dividend raised to the power of 1/9 because it's 9 years there. So that gives us the geometric average return, subtract 1. So the average geometric growth rate in dividends for Coca-Cola over the past 9 years has been 6.87%. And I might want to see it, how constant is that? That's the average. So I can look at year by year, what's the percentage? So here from 2010 to 2011, the dividend went from 88 cents to 94 cents. That's a growth of 6.82%. And then we can see going in 2012, it increased by 8.51, and then 2013 it increased by 9.8, 2014 8.9%, 2015 8.8, and then it starts to slow down again here, right? Down to going back to 5.7, 5.4, 2.56. So it looks like we had dividends around 6-7%, they kind of peaked out around 9%, and here in the last few years they've been dropping off. So before I really want to definitively say, yeah, Coca-Cola is a constant growth rate stock, I would want to do a little bit more digging, but maybe in 2019 and 2018, Coca-Cola had some acquisitions. They wanted to hold on to cash to make those acquisitions for whatever reason. So if this is just kind of a one-off, this slowdown in dividend, if I felt that was the case, then I would say, yeah, this is a constant growth rate stock, and I might use that 6.87% growth rate as my estimate in value in Coca-Cola stock.